It's time to have an intentional conversation at depth. I'm Ben Rodgers, and this is the At Depth podcast, where we explore the through lines that connect what we value to how we build business and how we invest. Each week, you'll hear from entrepreneurs of every kind, from small business startups to multi-generational companies and everything in between. As we explore ideas together, we're going to get below the surface, because it isn't just about what we build, it's about why we build it. I'm Ben Rodgers, your host. I've got Matthew Montgomery of Mavelo with me. This is a podcast where we're visioneering the through lines that connect what we value to how we lead brands, strategize in business, and invest our time and invest our dollars. Matthew?
Yeah, it's good to see you. Good to see you. It's been too long. Glad to connect and be on your podcast. Thanks for having me.
This is, long overdue. So it's funny, I was adding this up the other day. You and I have been technically invested together for 5 years.
Hadn't it really been 5 years already? I mean, that's crazy.
5 years. I invested personally in Fund 1, Mavelo Fund 1, and now you are on Fund 4. And I think the most exciting part of this conversation should be could you just real quick tell us about Matthew Montgomery, landman, Texas, Louisiana, to a napkin, to the first fund 5 years ago?
And it always feels a bit strange when you have to talk about yourself, but let's frame the story a little bit, right? I'm a Texas native. I grew up in North Central Texas. I grew up in a small town south of Dallas. Married my wife. She's from West Texas. The best way to frame it is I've always just really had an entrepreneurial itch. I was around business owners and business builders from an early age. My dad was a community banker, and so got to see a lot of these guys that really always had this knack of taking an idea or a concept or friends or partners and turning it into either a thriving business or an opportunity. Fast forward, I got a degree in business administration at UTA, and so much of the oil and gas business is serendipity, right?
Oh, yeah.
My serendipity was the Barnett Shale was really in its infancy and took off at the same time that I graduated, got out of school. I was really fortunate to find myself as kind of landman number 1 or 2 or 3, something really early with Larry Dale in Dallas, and got to sit really in his hip pocket and learn the business. And I was so fascinated by it because it was really interesting, fast-paced. No day was the same as the previous. And got to see really an entrepreneur and a business builder and ask really, really naive questions like we all do when we're young.
What was the thing that you learned in that season? The one thing that really stands out to you that just you went from being a kid to someone else?
Oh, man, I say this now because I've got a 17-year-old that's really starting to look into going to college himself. But
yeah,
I think I maybe not learned, but just did well, was just do the small things really well, right? Like I was really good at making coffee. I was really good about being on time. I was really good about being responsive. I was really clear in communication because I had no background in oil and gas. I'm not an engineer. I'm not a geologist by trade. I'm not a technical person. I think we've heard it plenty of times before, like your 20s is nothing but learning, right? And your 30s are all about earning. And then hopefully by your 40s and later, you're investing. And so that stuck with me early on. Do the little things, just be really good at those, and they'll lead to obviously more opportunity, more responsibility. And that's what happened to my career early on in my 20s. I got an opportunity to move to Louisiana and manage a very large brokerage business for Larry Dale. That led to just more doors opening and making relationships and meeting people and taking care of people. And ultimately it led my career to an in-house job here in Denver. That's what moved us to Denver. We thought we'd be here for maybe 2 or 3 years. We've been here for 13.
Oh, that's the way it goes.
Yeah, that's the way it goes. But along the way, Ben, I've always had this entrepreneurial itch. And so I've got some good buddies even that are in Oklahoma City. They're like, you're not that good of a landman, but you always are looking at ways to how do we figure out how to make money in this proposition? Is it an ice cream business? Is it oil and gas? Is it real estate? Is it real estate development? Is it buy and flip? The largest company I ever worked for was here in Denver. And at its height, when I was there were 30 people there. And man, I walked around, it felt like we were working at Walmart. It's got 2 million people. There's just like all these different departments and VPs. And that was very square peg, round hole.
It was the big company. I mean, it was you're a number, not a name type scenario.
It felt that way. I mean, it's still looking back, it still had a very, very much of an entrepreneurial feel, right? Like, don't get me wrong. I've got plenty of friends that work at very, very big companies. And man, we talk about it all the time. I was like, man, it makes my skin crawl kind of thinking through that process. And so it's always been an itch that I wanted to scratch of hanging my own shingle and just going out and trying to build a platform and build a business. I can remember my first goal in 2018. I started Mavelo in 2018 and we started our first fund in 2020. But that 24 months in between, it was, how do we make enough money so they don't have to go back and work in corporate America? That was the goal. That's all that it was. But too often, founders or entrepreneurs, particularly when they're really, really young, maybe in their 20s, I went out on my own in my later 30s, but they want to go out and they want to get a big office, they get a big staff, and they want to have kind of the perks and the conference room. And I kind of went the opposite way, started in my basement on a fold-out table. Not because it was like I wanted to have this like Jeff Bezos kind of story. I just wanted to make sure that I didn't have to find myself in a situation where I had to go back to corporate America. And so that was the mindset, and that's what we did. And those were kind of the steps that we took.
Describe the feeling of being in the basement. Cause I started one of my businesses I was in the back room, the back unused bedroom of the house we were renting at the time. And I remember having these moments, you've been by yourself for maybe like 5 or 6 hours at that point in time, kind of the end of the day. You haven't seen anyone. You've done a lot that you hope was helpful to the dream that's in your mind. I mean, what did it feel like to you in those moments?
I'd have a lot of parallel. There were days where it was very liberating to be like, okay, I hung my own shingle, and like big moments were like, we got our email address, we have a website, like little milestones that mattered. I don't know if they really matter, but they were important at the time. And so those little W's that you could get added up really quickly. A good friend of mine, Greg Taylor, and we would talk usually every week. Sometimes we'd go every kind of 2 weeks or so. And we would always kind of talk through, what are our W's and L's? What did we accomplish and not? And I learned really quickly, it's just as important, if not more important, talking about the L's. What's frustrating? What's bottlenecking? What can't you solve for? So it felt very, what's the word? Maybe sterile. I had this space to really like think deeply about where we wanted to go, what's my strategic plan, and write a business plan. And that quiet time and like non-distracted hours were vast, right, compared to working at a company. But you're right. I mean, you kind of get past the lunch hour and then you kind of start like, well, maybe this is the greatest idea that anyone has ever thought of. And then you realize, no, I'm just in my basement by myself. You need to I needed to find an avenue of soundboard. And how can I put this out to someone? Because at that time, you kind of have this like little bitty, like little ember of a flame. But I don't even know if it's that, right? It's like,
it's a baby spark.
It's like this little bitty, little bitty tiny little thing. Like the softest breeze will blow out your whole dream. You want to be very guarded with like who you share that with. Yeah. And of course, it's like you share it with your closest, right? So you take it to I said to my wife, and she's like, okay, yeah, like I think that's good, but her focus is on the kiddos, right? As it has been and should be and will always be, and that's why we work so well together. I learned through that process was find the right people to share this idea with, and it was my idea, and so I was very, very guarded early on about who I wanted to share that little concept and dream, and who I wanted to share that with.
Whenever you did kind of decide, I'm going to open this dream up to somebody, what kind of person, obviously there was Greg in the mix, but what kind of person did you feel safe sort of sharing the little baby dream with?
I laugh now, but when I was doing it, I can remember saying often, like I wanted to bring a lot of gray hair around the table. And it's like, now it's like, okay, well, that kind of backfired right into my own face.
You self-created that dream.
Yeah. No, it's I was really in a search for wisdom and sage, and I wanted to find not just guys in the oil and gas business. I wanted to find successful, thoughtful entrepreneurs that measure success in a lot of different ways, not just money go up. I've heard it said often, like too frequently, we as a culture just obsess over this y-axis. Money go up, number go up, value go up, assets go up. I didn't really have this clarity at the time. I do, and I do now looking back on it. Was I wanted to bring people around the table that could really coach me, mentor me, guide me on the successes of what it looks like to have your own shingles, right? Whether it's a big business or a family office or a 10-person crew or a 2-person, like what does that look like and feel like? And almost always I can call on these people and they say, well, I've done this, about 45 different ways. So how can I help you? At first it frustrated me, but at the same time, I realized the optionality and the discussion is really what I'm after. Not to say I need the exact sheet from the playbook or this exact play, but I needed that conversation to be like, okay, there's a lot of ways to solve this problem or work through this. So finding someone I could soundboard was huge.
And people have solved it in the past. You're not the first person to ever solve a wild business question. That's an interesting point about coaching. I heard this stat recently. They did a study of all solopreneurs and entrepreneurs who still worked in their businesses across the United States. And the sample size was thousands. I mean, it was an enormous sample size. And they said that something like 76% of entrepreneurs, the greatest negative force in their life was isolation.
Yep. I could see that. I'm a very social person. Like I totally resonate with that. It was early on, it was great to kind of like incubate, right? Like find this space to incubate in, but I wasn't there very long before you kind of pull back and go, golly, I gotta share this and get some feedback and have some other people around the table with me to help make this thing go.
And it's difficult because you can't always, there's a level where it's not appropriate to go walk into your assistant's office and just say, hey, I've got to get something off my chest. I think you have to operate with a lot of transparency, but there is a degree of separation that you do have to operate with too, because like you said earlier, and probably for good cause, and we can dive into that, you didn't want to just go spin your idea out to every Tom, Dick, and Harry who asked you about it. It felt like this precious little flame, this little spark of an idea, and you don't want to let too many people breathe on it, else someone's going to snuff it out.
I'm going to steal a line that I'll also learn from Greg Taylor is you have to be a bit crazy and out of your mind to have 3 kids, middle school and down, and a successful marriage, and then go out on your own. And the idea is like, I'm going to hang up shingle in my basement. Yes, you have to be motivated and you have to have entrepreneurial dreams. You got to set goals, like all the things that you kind of like reading in the books, but you have to have a little bit of screws loose.
Mm-hmm. So it's interesting. You talked a little bit about finding people who measure success in different ways, more than just dollars and cents and decimal places. And something early on that you and I did together is we worked to identify the why, how, and what of Mavelo. It's interesting because your why statement is to reflect authenticity. And we had a lot of good components here that came into that. I'd love to just read you a little quote from Matthew Montgomery. I'll read you a little quote from yourself. This was something that we did early. This was years ago, and it's evolved since then. And you said, we will look every partner in the face and know them. We will care for one another enough to be bold and be honest, which is a big thing for a little spark to be saying at the time. As I look at your business now and what you've built, I really see that as being, you do operate with a lot of care for people. And you do act boldly. I mean, you're not timid. You don't let that care sort of shut you down from a big idea. And there is this desire to just look people in the eye and say, this is what I think about this. This is what I think will work. This is what I think will not work. What has it been like to live up to that? Because that's a different scale of success, right? You're looking at yourself saying like, how good am I doing at living into this authenticity, into who I am? Do you feel like that's gone well in the past 5 years? Has there been a challenge in the past 5 years?
I still feel very moved by that. I still feel the exact same way. I tell my team now, I'm the one that's a bit sick in the head. I obsess so much over what does the investor, what does the LP think, and more importantly, feel. Unfortunately, probably because of this gray hair now, I hope that they feel better than I think that they feel. we move very quickly and very sharp, and we agonize over how we look at opportunities in the oil and gas space. But at the same time, I constantly think about, what haven't I done? How could I communicate better? We are stewarding a lot of people's money, and there's no institutional investor with us. And that's okay. That's in part by design. And so almost all of our investors' capital comes from a personal checkbook they write. When you go out and you raise money and people write a check from their personal checkbook, it's not an institution or it's not a pension. It's different. It carries a heavy weight. Through all of that, I resonate deeply and heavily on the word authentic. It's profoundly important. And look, I've stubbed my toe. I think the easiest thing to do is be authentic when you have lots of W's. It's really hard, but if you're going to be the guy that goes out on your own, and I think it's a piece of the recipe of why we've been able to sustain our business, is to be authentic in the L's.
Yes.
And that's hard. It's really hard.
Oh, it's terrible.
You don't want to let anybody down. What I've learned too is that my partners value that almost more than the W on the spreadsheet. Of course, everyone loves to get a return and, like they got to see return on capital, but it's never going to go as you draw it up. It's just not going to. And so you better be prepared to have the heartbeat and the authenticity part to say, like, market didn't pan out like we had anticipated. Or, I probably could communicate more frequently or in a different way. The kind of partners that we have, they'll look at that and go, this dude's giving me everything he's got, right? They're never going to say like, well, I wonder if Montgomery is on the golf course. No, there's never a day that a partner calls and says like, I don't think he's even at the office. Like, they all know that I agonize over it. And again, it's kind of one of those sick in the head kind of things. The word authentic is a very important word for me. I just feel that it has a lot of weight on my shoulders of making sure that we're saying what's authentic about what's happened. And here's how we got ourselves in this situation. And we're in the boat right beside you. Like we do that. Not all the time will it be just roses. And so you need to be on both sides. And when you do capture those W's, they're there to high five. And when you don't, what I've learned is being consistent enough in that kind of heartbeat that partners go, well, I know, Matthew, I know where you're at. I can appreciate as a business builder myself. Most of my investors are business builders themselves. And they go, I get it. Like, stubbing your toe is part of this business building kind of thing.
We once did an interview process for another fund, and we asked people maybe a little less directly than I'm going to phrase the question here, but we said basically, what does it take for you to never invest with someone ever again? It was astounding how the answer was not, if they lose me money, I'll never invest with them ever again. The most predominant response was, when people cease to be communicative. That is when, if I know that someone's going to crawl in a hole and start to crawfish when something goes sideways, that is the number one disqualifier. I'll never invest with them ever again. And I really put this to people. I said, honestly, like, you tell me stories then of when you have reinvested with people that have lost your money. And everyone had a story like, really and truly, you get a generous number of strikes before people just say, oh, well, maybe this isn't your skill. The moment you start crawling into a hole and backing yourself, into that isolation space again. And isn't that interesting, right? So the number one thing that entrepreneurs are suffering with these days is a sense of isolation. And the number one thing that alienates people is habits born from isolation. And so when you look at a purpose statement that says we're here to reflect authenticity, there is very much that word reflect is as prominent as the word authenticity, right? Our faces are going to be at each other's faces.
Yeah.
You started that quote with, we will look every partner in the face and know them. And that sets you up for a dynamic that is honest, open, probably a little real, maybe sometimes a little too real at the W's and the L's. I mean, people could look in the eye and be like, I think that was stupid. And you're opening yourself up to saying like, oh yeah, that probably was stupid. I'm sorry.
It's kind of the price of poker, right? Either you want to go out and build a business or you don't. If you're not willing to, in my small opinion, if you're not willing to put yourself out there to have that level of criticism, don't be in the market to raise other people's money. And it's okay. Like I've had plenty of LPs ask and criticize and say, hey, like this isn't the same as it was last year. I was like, well, okay, so let's back up and make sure that we're on the same wavelength. Because I promise you, I'm putting wavelengths out. We just need to make sure we're fine tuning our radio so you're hearing where we're going, and I can hear and receive where it is that I messed up at the same time.
I want to talk a little bit about that after we talk about what Mavelo is today, because this little spark napkin idea gone basement, it doesn't look like you're in the basement anymore back there behind you.
We actually have a little office. I got a little window. We graduated. We crawl, walk, run. We went from basement to, I say, the broom closet. We rented a small little, just one suite little office. It was over across the parking lot from where we're at now. And then we hired some help. We were dangerously I was spinning too many plates in too many directions. So we hired some people. Got Chris that's here with me now full time. And then we have Karen that's with us remotely. And she handles a lot of the heavy lifting for us, no question. Now, I get a lot of questions about Mavelo and what is a Mavelo, right? Like, what is that?
What's a Mavelo?
Yeah, what is
I think
that?
that's a good one. What's a Mavelo?
So it was back to the basement days. I was putting together the LLC docs and registration and all those kind of like small W's. I had this kind of idea, I think is maybe glorifying it some, but I wanted to have this angel oak. There's an angel oak, and it's called the Angel Oak in South Carolina. And if you haven't seen it, Google it. It's beautiful. It's said to be the oldest oak tree in the country. And they believe that it's not been cut down, so they don't know the exact age, but they believe that it's older than the Constitution. And it has this massive spread of branches that go up and then back down. I mean, it's ginormous, right? And so the idea was, if we can root ourselves in the skill set that we have here at Mavelo, that will ultimately one day lead us to these long-standing branches that give us shade and give us fruit and give us yield and that sort of thing. And so the idea was always named Angel Oak or Angel Oak Partners or something like that. Well, guess what? Someone else, lots of other dudes had that same idea. And so I was like, I gotta get this done. I get this form. I took the first two letters of each of my wife and I's three kiddos. Our kids' names are Mason, Evie, and Lottie. And so Mavelo, smash those together. And then bang, you go to the registration office and there is no Mavelo ever filed. And so there we go.
It's the first one.
It's the first one, yeah. And so we have Mavelo Company. That's our parent company that I invest through. And then we stand up different funds and different special purpose vehicles and investment opportunities that have different Mavelo. We have Mavelo Production. We have Mavelo Resources. And we've gone about it that way. It's also been really cool. When you put your kid's name on something, it will slow you down.
Mm-hmm.
I think for me, that's been really good. I want to go fast all the time. You slow down and you think about I'm putting my kids' initials on everything that we do, everything that we invest in, all the partners that I have, vendors that we talk to. That's been good for me to help slow things down a little bit. And of course, have strong heartstrings to that name as well. It's my three kids. So yeah, that's where Mavelo comes from.
So let's talk about what all of the different things are that you are in. You've got Fund 1 was royalties. Fund 2 was more gas royalties. And maybe I know there are going to be some people listening to this podcast who don't know what an oil and gas royalty is, but I know you also do some non-op working interest as well. You've got Fund 1, Fund 2, Fund 3, and you're just launching Fund 4 for a total of how many investors? Give me the quick stats on what Mavelo looks like today.
Today, we manage just under $30 million of AUM. That's just a very easy measure of capital that's coming in the door that we are stewards of and go and invest. A lot of people say, what is that worth today? What is total, mark to market? And that's a very fluid and changing number depending on the price of oil and gas. So we just look at it and say, we've been blessed that people want to put money with us and through us to make these investments for them. Let me take one step back. And so by trade, I'm a landman. I get a lot of, it's just like the TV show Billy Bob Thornton. It's like, no, of course not. No, it's not that sensationalized. I promise you. What we do inside of our vehicles, if we think back to the basement days, I was really just kind of white knuckling this thing to make sure that we didn't have to go, or I didn't have to go back to corporate America. And so I was doing brokerage work. I was actually an expert witness on a very, very substantial piece of litigation in Texas as a landman. And so it was really just kind of spinning as fast as we could. And through that course, I would see opportunities to buy fractional pieces of land. And on those lands where the opportunity either had producing wells on them or the foresight that more wells would be drilled on those lands. Because of my previous kind of like 15 years at the time, I'd worked in Louisiana and Texas, obviously lived here in Colorado, parts of Wyoming and North Dakota and South Dakota. I was involved in some other partnerships in West Virginia and Pennsylvania as well. So we kind of had this huge coverage area. And so we saw these opportunities come across, and I made a few investments myself and still saw more deals come across that I didn't have enough capital to buy these really good deals. And that's where the idea came to, like, let's pool some capital. Let's talk to that small group. We had 14 investors in our first fund. We doubled that to just right over 30 in our second fund, total number of LPs. In our third fund, we went up to 57, and we've raised a bit more each iteration. I get a lot of some of the institutional investors in our space will look at, like, what's your expertise? What basin? Tell me what counties you're gonna invest in. And that makes me want to jump out the window. The idea here is to be strong stewards of other people's money. And our goal here is to deploy that capital in the best basins that we can for the opportunity set that we see. So by way of example, our first fund, we were deeply invested in parts of Wyoming. So it was very liquid forward. That was a really special time. We bought in on the heels of COVID. We were underwriting this deal, and we had no idea if oil would ever reach $30 a barrel ever again, right? And so that obviously didn't happen, and it took time, but the industry came back and drilling activity took off, and that was a great vehicle for us. Our second and our third funds are deeply invested in natural gas. We have a very bullish and long-term natural gas thesis here at Mavelo. We still buy oil properties. We still buy opportunities in oil. So we're deeply invested in natural gas, particularly in East Texas and parts of Northwest Louisiana. Those are the closest, largest basins to the LNG phenomenon that's happening in our country right now. So that's why we're there. Fund 4 is a little bit different. We're adding a little twist to it.
A little lemon twist.
Well, yeah, a little extra spark, as you would say.
Yeah, oh yeah.
We've gone down this rabbit hole of sound money and what is now just now in the last, call it maybe 30, 60 days, being called debasement trade. We're seeing more and more of the United States dollar being debased and devalued through our own doing. And so inside of Fund 4, we buy Bitcoin and hold it on the balance sheet. And so a lot of people, I was on a panel last week in Houston with a lot of like super huge pensions, and we're talking hundreds of billions of dollars of these guys. And I said, we put Bitcoin on our balance sheet. I mean, you could hear everyone be like, what did he just say? So it was really interesting. I know I hit the right chord though, because after the panel was over, we had 40, 50 some odd people call up, and we were talking strategy of why we're doing it and what does it look like and how do you do it. So it's been really interesting. We view that as a value accretive component. What's been fun about it though, Ben, is I've been able to scratch that entrepreneurial itch, but I never make it a mandate. I've never put it in our fourth fund and said, if you want to invest in oil and gas with us at Mavelo, you have to swaddle this Bitcoin. No, we've just said this is an option. And these are the themes and the research and the thesis and the economic underwriting of how we view it. It's an option value to it. You don't have to invest in the Bitcoin at all. And it doesn't change the metrics of how we invest in oil and gas. But what's been super interesting in this process is, as we've been raising money for our fourth fund, every single one of our investors that's in the fund so far has taken an option to be exposed to Bitcoin in some proportion, some allocation. I did not expect that. There's a couple of variables like, why is that? I think they've ridden Fund 1 or 2 or 3 with us, and they understand the cadence of what we're doing. But a lot of it is the view of where we're at in the world, right? I mean, you kind of have to ask yourself, are we in an analog world or a digital world? Like you and I know the answer to that question, but a lot of people still wrestle with where they're at. Where are we at? So it's been a really fun, engaging conversation. Lots of conversations we've had with our partners, and we put that option to them, and we love them all the same.
So let's stand up a few pillars here. I know in oil and gas, there's royalties, and I'd love for you to just kind of quickly tell me what these different things are. You've got an oil and gas mineral right. You've got a non-operated working interest. And then you've got this other thing over here you called sound money. Tell me what each of those three things are. And then I want to move with you through a bit of a thought, but just in case people don't know what each of those three things are, and add it, if I'm missing anything else, I'm pretty sure people know what real estate is.
So mineral rights, here's how it was taught to me. When you think about real property, right? And so everyone kind of understands personal property, right? You don't have to be an economist to understand personal property, right? It's a tangible thing, your car, baseball cards, your backpack, personal property. I'm in the world of real property. So real estate is obviously that one. Land is real property. And in the United States, in real property law, there's a theory called bundle of sticks. And so inside the bundle of sticks, if I held, here we go. I'm holding this bundle of sticks. Okay. Now, if a piece of property is made up of a component of all these different ownership rights. And so let me hold still here. One of these could be surface rights. Okay. That could be owned by Ben. Another one could be riparian rights or water rights. I'll put this one over here. Another one could be executive rights. So you basically have stewardship over the land, but really no economic compensation. Then, as a part of the bundle of sticks, you have mineral rights. And this includes oil and gas, but it also includes gold or diamonds or gravel or sand. All of the rights held together are what we call fee simple absolute title in real property. And so in my world, what we look at is the oil and gas rights. So we're only interested in this one stick. We're only interested in this one part of the real property to any piece of land that we're looking at. And so what makes this a really dynamic industry is you can have different owners to all of these different sticks. So Ben, you could be at your place and own the surface to a piece of land in Oklahoma. And I could be here in Denver and own the other stick that's the mineral rights to the same piece of property located in Oklahoma. When we talk about our mineral funds and our royalty funds, we're taking direct ownership. We purchase the mineral rights, just the one stick, to pieces of land all over the country. And very kind of 50,000 foot, we buy in basins that have historical production records. So another way of saying that is we're not buying mineral rights in the state of Indiana. Why? There's no oil and gas there. It's pretty simple, right?
That we know of.
Yeah, no. And so when we buy mineral interest to a 5-acre tract or a 10-acre parcel or a 200-acre parcel or a 2,000-acre parcel, we own a fractional piece of the land that is in across all these different basins. Some are gassy, some are oily, some are more drilled out than others. Mineral and royalty investing, if you think about kind of the risk-reward spectrum of the oil and gas side, is probably, I would say, the least risky, most predictable place to invest if you're looking for an alternative investment directly into the energy space.
Because you kind of know what you're getting. I mean, you've got a reserve report, engineering report that says this juice, I love calling it the juice. There is this much juice in this land, and I mean, there's a way to value it. You're not kind of guessing.
There's kind of a two-pronged piece here that I think is deeply interesting in the mineral and royalty space. And that is you are a cost-free, burdened estate. It's like, well, okay. Those are like the biggest words ever for little men.
That's right.
What does that mean? Here's what that means. When an oil company, pick one, Exxon, Chevron, or kind of household names we all know, if they see and come out and want to drill on that piece of land that has the mineral rights that you own, well, guess what? Chevron is an expert in poking a hole in the earth and extracting the juice, as you call it, out of the ground. That's what they're good at. really not much good at much else. They don't want to own the minerals. They want to lease the minerals from the mineral owner. And in exchange for that contract, I'll say, look, you go do all the drilling, you go do all the geology, put up with the regulatory, put up all the money and risk to go drill that well. And if you are successful, I want a percentage of the production that comes out of the ground. That's your royalty associated with your mineral interest that you own. And so it puts you in a position to own really kind of what we tell our investors is that our mineral funds are a shotgun spray of diversification of our capital across multiple tracks that give us lots of diversification with operators. Right? Those are the guys that are actually drilling the hole in the ground. And it also gives us diversification of the hydrocarbon, meaning are we in liquids? Are we in wet gas windows? Or are we in dry gas windows? And there's strategy behind all of that we agonize on, right?
Because they all come out at different prices at different times. Oil can be up one day, gas is down. Different speeds. There's different amounts of each of these things under the ground. So you can mix and match those literally all over the country to kind of
Ben,
get your mix.
You can get so geeked out. I can't on the technical side of it, right? Like we probably need to start a new podcast, but it's but the point being is that for a first time investor, someone that's looking to have an energy exposure, this is a place where they can invest in land, in real property, and understand that has the opportunity to produce cash flows from wells drilled, but you have no liability and no capital exposure for those wells to be drilled.
Which is different from working interest because that you do have exposure. So that's kind of that's sitting next to Exxon or whoever's poking the hole in the ground to go get the juice.
Yep.
And that's a different way to invest, but you do that too.
Different kind of strategy, much more technical. We've had half a dozen or so of our investor base come to us and said, hey, like we understand we like the mineral proposition. It's a long term, it's a great store of value. There's a scarce asset. Time will eventually prove out as they drill more wells. Where can we invest in the energy risk reward spectrum that is a little faster pace to see our investment come back to us? Okay, well, how big old boy are you, right? That's
right. How much risk do you want to take now?
Yep, that's it. That's an investment in what we call non-op working interest. So we are not the operator, but we partner directly with an operator and we take ownership in the wellbore itself. Okay, not necessarily in the land. Easiest way to remember this or think about this is now you're hunting with a deer rifle. And your kills are much bigger, right? You're not dove or quail hunting as you would be with minerals, where we spread that investment out. But we very pragmatically and take crawl, walk, run. We've put some deals together where we invest directly in the wellbore. We've got some opportunities that came together in Utah as well as in North Dakota. And we've got a handful more that we're looking at. It is a faster pace of development. Your capital usually is called all at one time. You pay for the cost of that well. You are exposed to the liability of that well.
If they go over budget, you got to pay for it.
Yes. Yes, you do.
Last one is sound money, and I know you're going to have a hard time keeping this one, but you have one of the simplest relations, I think, of sound money out there. So that's kind of the last pillar. You've got these mineral rights is kind of one pillar, and then you've got some of this non-op development, sort of working interest, a little faster, different kind of shape of the money. I'll talk about that probably in a different podcast. But then over here, you're concentrating on the idea of sound money. So talk a little bit about sound money versus the opposite, unsound money.
One of the biggest ethos around Mavelo is family life investing. And I like to say we do all of those 100% of the time with 100% of our effort. It kind of just hit me in the face one afternoon when my wife and I have 3 kiddos. The 5 of us were going to the drive-thru at Chick-fil-A, and they hand you all the food and milkshakes and all comes back, and it's almost $100. Now, okay, I do have a teenage son. He eats a ton, but still, we're talking about chicken and french fries, bud.
Why is it $100?
Well, it's this sound money concept, right? It's this component. A lot of people get really flustered, and puffed up about inflation. And so it led me down this rabbit hole to really understand monetary cycles and monetary policy of what was happening. As a business owner, it's great if we're working really hard and we have these old W's and we successfully execute the strategy. And in oil and gas, if you serendipitously time the markets and get in and get out, but what does it matter if the unit of measure, which in the case of directly in our investments is the United States dollar, what if that unit of measure were changing? And that's where it hit me is that happening? And to my own research, it is not only happening now, but it's happened since they started the Federal Reserve in 1913. What really kind of spurred this was, where is the soundest unit of measure? A lot of people will say gold. I think land is in that conversation. Gold is in that conversation. And what we're doing in our fourth fund is Bitcoin, what we believe is the apex of sound money. And so we're trying to go, well, what is sound money? Sound money is this unit of measure that has the closest, or in Bitcoin's world, a measure that is in finite supply. We're really after scarcity is what we're after. Because if we change the unit of measure like the United States dollar, where we print more money in cycles and we have booms and bust cycles, we can all look back. I mean, the 2020, 2008,